War in West Asia is once again rattling global markets. Oil prices are climbing and investors are turning cautious. This week, Indian benchmark indices slipped to multi-month lows, with the Sensex falling more than 2,500 points in the first two trading sessions. Sentiment improved slightly on Thursday when both the Sensex and the Nifty 50 rose over 1%, but uncertainty remains. So what does this geopolitical escalation mean for Indian equities? And what should investors expect next? Let's look at how major brokerages and market experts are assessing the risks. The biggest concern right now is oil. India imports a large share of its energy needs, with roughly 50 to 55% of its crude oil and LNG coming from the Middle East. Any disruption to shipping routes, particularly around the Strait of Hormuz, could push oil prices significantly higher. Now, historically, geopolitical crises have driven oil prices up by anywhere from 25% to as much as 300%, although many of those spikes eventually eased as supply adjusted. During such periods, markets typically shift into a risk-off mode, with investors becoming more cautious. Some analysts warn that if crude prices continue to rise, Indian markets could see a short-term correction of around 1 to 1.5%. Not all brokerages see the current volatility as purely negative. Phillip Capital believes the situation could present a buying opportunity for long-term investors. According to the brokerage, the conflict may create a temporary overhang due to oil price risks, but markets are likely to stabilize over time. Phillip Capital has maintained its Nifty target of 26,500 to 27,500 by March 2027. The brokerage advises investors to focus on large-cap stocks and high-quality mid-caps, especially during market dips. Sectors expected to drive earnings growth include capital goods, defense, automobiles, cement, and non-banking financial companies. Among its preferred stocks are Larsen & Toubro, HAL, BEL, Ultratech Cement, Axis Bank, Hindalco, Titan, Ashok Leyland, and Tata Steel. However, not all sectors may benefit. Brokerage Emkay Global warns that the specialty chemicals sector could face disruptions if the conflict affects supply chains in the Middle East. India depends heavily on the region for petrochemical inputs such as propylene, methanol, styrene, and polymers. Emkay estimates prices across the chemical value chain could rise by 10 to 20% in the near term. The brokerage recommends a selective approach, favoring companies that are less dependent on Middle Eastern supply chains. Its preferred picks include Navin Fluorine, Gujarat Fluorochemicals, Atul, GHCL, and Epigrill. Veteran investor Jim Rogers, chairman of Roger Holdings, notes that markets have historically recovered from geopolitical shocks. While markets may react sharply in the short term, they typically adjust once uncertainty begins to ease. In the near term, volatility is likely to persist. Oil prices, global risk sentiment, and foreign investor flows will remain key drivers of market direction. But history suggests that geopolitical crises often trigger temporary corrections rather than lasting damage to markets. For more such market explainers and analysis, follow Business Standard.